Okay, so when you think about investing, what image comes to mind? Like, is it the classic Wall Street vibe, suits and ties?
Or is it more the hoodies and crypto memes? That kind of digital frontier look.
Exactly. It's funny how, for so many people, it feels like those are two totally different universes.
Yeah, they really do see it that way. The investing world kind of feels split, doesn't it?
Yeah.
You've got traditional finance, TradFi, super structured, decades of history, all the regulation.
Right, the established way.
And then bam, you've got crypto, full of innovation, moving incredibly fast. And yeah, let's be honest, sometimes it feels a bit chaotic.
For sure. And that leads to this core problem. Maybe you've felt this too listening in, this idea that you have to pick a side. It's like, okay, am I doing stocks or am I doing crypto?
Safe and steady or risky and cutting edge.
Yeah, that feeling of being pushed into one camp or the other. It's really common.
But here's a thought. What if the smartest thing you could do right now
Mm.
is actually not choosing at all?
Okay, see, no, that's interesting. And that's really what we want to dig into in this deep dive. We're going to explore how maybe blending the best bits of both worlds,
Yeah.
what we're calling hybrid investing,
Yeah.
how that might just be the new cheat code for building wealth.
Finding that sweet spot in the middle.
Exactly. It's about creating something stronger than either part on its own.
And we should be really clear up front. This isn't about like bashing TradFi or dissing crypto.
Oh, absolutely not.
Both sides bring, huge value to the table.
Totally. I mean, think about traditional finance. It's given us decades of strategies that genuinely work.
Proven stuff.
Dividends, the ease of ETFs, those exchange-traded funds, buying a whole basket of stocks easily.
Compound interest.
The fundamentals.
Yeah, the magic of compound interest. It's solid, it's reliable, it's built fortunes. It's definitely not broken.
Not at all. But then you look at crypto, wow. I mean, it brought us decentralization, incredible innovation, and it's opened up access to finance for so many people around the world. People who are kind of left out by the old systems.
Right. It's not just, evolving. It's actually changing what people think is possible with money.
Okay, but here's the rub, the critical issue we see again and again. Most investors, maybe even you listening, they tend to put themselves in a box, a silo.
Yeah, they pick a lane.
Right. So they either stick only with TradFi, which feels safe, maybe too safe sometimes.
And they miss out on potentially huge growth elsewhere.
Exactly. Or, the flip side, they jump headfirst into crypto, maybe without a real strategy.
No plan, just hype.
And unfortunately, while they can get wrecked, we've all seen the stories.
That's just a fact. It happens. And that's really where this hybrid idea comes in so strongly. It's not about chasing the hottest trend of the week.
No FOMO investing here.
Not at all. It's about setting up diversification that actually makes sense for the world we live in today, a world with both established markets and these new digital ones.
Yeah.
It's a more thoughtful, integrated way to think about it.
You're so right. Because, real diversification today isn't just that old advice of get some stocks and get some bonds.
That's baseline, maybe. Foundational.
Yeah, it's still important, but it just doesn't cover everything that's out there now. The opportunities, the different kinds of risks. It's not quite enough anymore for a truly robust portfolio.
And what's really cool is how much bigger the idea of diversification has become. A modern hybrid portfolio, it could look like, well, maybe some low-cost ETFs tracking the whole market, like VOO for the S&P 500, right? Big U.S. companies.
Okay, solid base.
Then you layer on maybe some blue chip stocks,
Yeah.
The big, reliable companies, financially sound, been around forever.
The household names. So that's the TradFi anchor. How does crypto weave into that?
Okay, so then you might integrate things like stable coins. These are cryptos pegged to, say, the US dollar, designed to be stable. And they get really interesting when they're earning yield,
Earning income. How?
often through things like DeFi lending protocols. You can offer a pretty steady income stream, usually much higher than a bank account, though with different risks, of course. Then maybe you look at staking platforms.
Right, where you lock up crypto to help run the network and earn rewards.
Exactly. It's kind of like earning interest, but decentralized.
Mm.
And yeah, maybe a small strategic bit of Bitcoin, perhaps some Ethereum, and alongside that, maybe some growth tech stocks, companies really pushing the envelope.
And maybe if you're feeling a bit cautious, you throw in some U.S. Treasuries, just for that extra layer of safety.
Absolutely. Why not? It's
Yeah.
all about building that intentional risk balance across different types of assets. You're not all in on one thing.
Okay, let's make this super practical then, because talking theory is one thing, but let's, do the deep dive. Say someone listening has $100 they want to invest, just starting out. How might a hybrid thinker break that down? Not advice, obviously, but like a framework example.
Great question. Yeah, definitely not financial advice, just illustrative. But think about building like a financial engine. Every part has a job.
An engine. I like that.
So maybe you start with $30, put that into a low-risk, broad ETF like VOO. That's your engine's solid frame, right? Instant diversification across big companies, stability, long-term growth potential, bedrock stuff.
Okay, $30 for the base. What's next for our engine?
Then maybe $25 goes into stable coins that are earning yield. Think of this as like a reliable, low-vibration power source. These aren't moonshots. They're digital dollars earning maybe 5%, 10%, sometimes more through DeFi. That income can be a buffer, or you reinvest it.
Interesting. So steady income from the digital side. What about the parts meant for growth?
Right, so next, maybe $20. This could go into a mix of established blue-chip stocks, your Apples, your Microsofts, or the more established cryptos like Bitcoin or Ethereum. This is like the main engine block. Good growth potential, but more mature, less crazy volatile than the brand new stuff. Aiming for solid appreciation here.
Okay, blending known growth with established crypto makes sense. What about the really high octane part, the turbocharger?
Ah, yes, that's where the next $15 could go, maybe into higher growth tech stocks or newer, more innovative crypto projects. This is where you could see exponential gains. But higher risk definitely needs more research. Volatility can be wild here.
Yeah.
But a small slice can potentially really boost the engine's overall power if it works out.
Got it. Higher risk, higher potential reward. And we still have a bit left over.
Exactly. The last $10.
Right.
Keep it in cash for flexibility, or maybe put it into short-term bonds or treasuries, super stable.
Yes.
This is your emergency breaker, your reserve fuel.
Dry powder.
Yeah, dry powder. So you can jump on opportunities, handle unexpected stuff, or just sleep better knowing you don't have to sell things at the wrong time.
Wow. Okay, looking at the $100 breakdown, $30 ETF, $25 stablecoin yield, $20 blue chip BTC ETH mix, $15 growth to altcoins, $10 cash bonds. It really does cover all the bases, doesn't it? Safety, income, growth, innovation, liquidity. It feels complete.
That's the beauty of it. You are deliberately not betting the farm on any single asset class or outcome. If stocks dip, maybe your stablecoin yield helps cushion things. If crypto has a rough patch, maybe your blue chips hold up okay. It's about building resilience for different market weather, you know?
Designing a portfolio that can handle different economic seasons and tech shifts.
Precisely.
And that brings us to the mindset, right? It's not just what you buy, it's how you think about it. These hybrid investors, they think in systems, like you said, with the engine analogy. The question isn't just what's hot right now. It's always, okay, how does this piece, TradFi or crypto, fit into my overall wealth building engine? Does it make the whole system stronger?
That bigger picture view, it changes everything. From isolated bets to an integrated strategy.
Can I say that again?
From isolated bets to an integrated strategy.
Yeah, you're building an engine, not buying a lottery ticket.
Exactly.
An engine needs design, assembly, maintenance, optimization. A lottery ticket is just hope and luck.
Yeah.
Big difference in approach. You're building something sustainable.
And think about risk, too. You're not trying to avoid risk entirely. That's impossible in investing. You're managing it by layering.
Right.
Maybe the stablecoin yield offsets some crypto volatility. Maybe the broad ETF provides a base if your growth picks take time. It's about smart trade-offs, complementary parts.
Okay, but what if someone listening is feeling, a bit overwhelmed? There's so many options out there. How do you even start building this engine?
Yeah, good point. It really starts with understanding yourself. What are your goals?
Yeah.
What's your actual tolerance for risk? Not what you wish it was, but what it really is.
Be honest with yourself.
Totally. If you're more conservative, maybe your engine has a bigger allocation to those ETFs, bonds, stablecoins. If you're younger, maybe more runway, higher risk appetite. You might dial up the growth tech and innovative crypto slices, but you still keep that solid base. The engine is custom tuned for you.
So it's not about finding the one perfect portfolio for everyone, but finding your right mix within this hybrid world. And I guess it's not static, right? Engines need tune-ups.
Oh, absolutely. Rebalancing is key. Over time, some parts of your engine will grow faster than others, right? Their percentage of the whole portfolio changes.
So you trim back the winners a bit.
Periodically, yeah. You trim the parts that have gotten too big, take some profits, and maybe add to the parts that have lagged behind, bringing things back towards your target percentages. It forces you to sell high and buy low, systematically. Keeps the engine balanced.
Okay, so that's kind of the big picture, the vibe of what we've dug into today. We've introduced this hybrid idea, shown a practical way to think about allocating money across old and new assets, and really hit on that mindset shift.
Engine, not lottery ticket.
Engine, not lottery ticket. Exactly. We've started exploring where TradFi and crypto can actually work together.
And, our goal is always to keep this stuff straightforward, actionable. No need for confusing charts or crazy jargon.
Just clear, honest talk.
Hopefully empowering you with stuff you can actually use.
So next time, we're going to keep going down this road. We'll unpack what really makes a strong core portfolio in this hybrid era. Like, what are the essential building blocks beyond just that first allocation?
And importantly, how can you actually build that core without needing, a PhD in finance or spending 50 hours on YouTube rabbit holes?
Yeah, we want to boil it down for you.
Cut through the noise.
So, look, if you're tired of feeling like investing means picking between these two extremes, the old school way or the Wild West crypto way, the super safe bet or the moonshot, you're definitely in the right place. We think there's a smarter, more integrated way.
And maybe here's a final thought to chew on from today's deep dive. How can you start thinking about your own investments, less like a random collection of bets, and more like the deliberate construction of your financial engine? What parts do you already have? What might you need to add or tune up to make it run better and get you where you want to go?
Something to think about. Until next time, keep building that engine.